Global stocks rise for the first time in 3 days, and sterling and the euro climb. Oil prices rise above $48 a barrel as investors take advantage of a 2-day slide in crude following Britain's vote to leave the European Union to lock in lower prices. Plus, the UK loses its top AAA credit rating from ratings agency S&P and Fitch following the country's Brexit vote. Good afternoon and welcome to Business Incorporated. I am Bolaji Akinwale. Let's begin by taking a look at the downgrade of UK's AAA credit ratings from rating agencies S&P following the country's Brexit vote. The rating agency says that the referendum result could lead to a deterioration of the UK's economic performance, including its large financial services sector. Rival agency Fitch also lowered its ratings from AA+ to AA, forecasting an abrupt slowdown in growth in the short term. The move comes after Chancellor George Osborne said that the UK will face the future from a position of strength. On Friday, Moody's cut the UK's credit rating outlook to negative. The International Monetary Fund says the Brexit referendum came as a shock to the global financial market, but it has stabilized following liquidity guarantees from central banks. The IMF Deputy Managing Director, Zhu Minwu, was speaking on the sidelines of this year's Summer Davos Forum in North China's Tianjin municipality, said that the impact of the geopolitical instability brought by the Brexit cannot be underestimated.
In
the short term, the market is obviously not well prepared for the outcome of the Brexit referendum. But central banks have guaranteed adequate liquidity, so the market has not panicked and has stabilized. The IMF has carried out analysis that says if the United Kingdom leaves the European Union, the country's GDP might drop 1.4% in the next 3 years. If the economy doesn't go well, people show a lack of confidence and investment reduces significantly, then the GDP could drop 5.6%.
And pressure has eased on UK financial markets after 2 days of turmoil in the wake of the Brexit vote, with the FTSE 100 share index opening higher. The pound also showed signs of recovery, rising 0.6% against the dollar to $1.33. Now let's cross over to Frankfurt to see how the market there is doing today. DWTV Channels TV financial correspondent Avi Aguedas joins me now. Avi, welcome to the program. The markets in the UK are looking up today after Brexit. How is the market where you're standing doing?
Well, the market is also doing quite well, but of course you have to put this into the dramatic context of the losses that we saw on Friday and on Monday. So what looks like a recovery does not necessarily mean that things are looking any better than before the UK decided to exit the European Union. But all in all, the DAX, the main German index, is up 2.7% as we speak, which is a quite solid recovery. This is more of a technical recovery after the losses. It does not mean that there's enthusiasm in the markets. What is in the markets is a lot of uncertainty about what can happen in the political level, not only in the European Union, where we know that countries could decide to leave the European Union just like the UK is planning to do so, or also instability and uncertainty in the side of the United Kingdom itself, because we know that the Scottish government is very critical about this decision process and has definitely not ruled out the possibility of going ahead with a new referendum to separate from the United Kingdom. So all these question marks are unresolved, and until we see some clarity ahead, we will continue to see turmoil in the markets because companies do not know what they are really confronted with.
Really. Now, the heads of the European Central Bank are having a strategic meeting in Sintra, Portugal. What is the likely focus of the meeting?
Well, the focus of the meeting is, of course, how stable the Eurozone and the European countries in general are at this point, and specifically how the banks are going to tackle what is going on. We saw tremendous losses in many of the most important banks in Europe yesterday, with banks in the UK, of course, losing heavily, but also, for example, Italian banks, which we know have been quite unstable. And the European Central Bank wants to make sure that the financial system is stable enough to cope with the consequences of this possibility of Britain actually leaving the European Union and what this will mean for the financial world. We do not know if the Eurozone specifically is truly prepared to confront the situation as well.
And just before I let you go, Javier, David Cameron is meeting with the EU leaders in Brussels tonight. What do you think is going to tell them, and what are the expected response?
Well, you know, David Cameron has had a couple of rough days. I don't think that there is that much that he has to say, considering that he, of course, is or was on the side of the European Union and didn't really want this to happen, even though he initiated the whole referendum process, or was one of the ones who decided to go for that referendum. But David Cameron knows that his country is now more or less in a position where they are definitely not in a rush to exit the European Union. They have not formally to do so, and the European Union, on the other hand, and that's probably the Kingdom, does not present a formal request to exit the European Union. Well, they won't take any further steps. So all in all, for investors, that means that right now, at this point, it is a scenario just like if there was no Brexit, because all things continue to run normally. What we are seeing are losses based on fears of what might happen, but nothing has actually happened yet. So that is why the conversations are quite tense, especially considering that the days of David Cameron as Prime Minister are counted.
Javier Arguedas, DWTV Channel 7 correspondent, thank you so much for your time. Moving on now, in Asia, Japanese shares continue to roll back losses from last Friday's sharp post-Brexit tumble after falling initially in morning trade. The Nikkei 225 index continued to build on Monday's gains and closed 0.1% higher. But with the yen remaining strong, Japanese exporters continue to suffer. Over in Hong Kong, the Hang Seng Index closed down 0.27%, while China's benchmark Shanghai Composite closed up 0.58%. Australia's ASX 200 in Sydney fell 0.7%. South Korea's benchmark Kospi was lower in morning trade, but ended the day 0.5% higher at 1,932 points. And Tokyo-based company Takata Corporation CEO Shingehisa Takada says he will resign after a new regime is found for the auto parts supplier finally bowing to calls to step down over a long-running recall crisis. Takata is seeking a financial backer to help it bear the costs of a massive global recall of potentially deadly airbags. Speaking at a shareholders meeting in Tokyo, Takada told investors he will stay in his role until a handover. As many as 30 potential investors have indicated initial interest in providing support for the company, and the new regime, Takada mentioned, likely refers to a team expected to take over once a deal is struck. And Volkswagen's settlement with nearly 500,000 US diesel owners and government regulators over pollutant vehicles is valued at more than $15 billion. The settlement to be announced today in Washington includes $10.033 billion to offer buybacks to owners of about 475,000 pollutant vehicles and nearly $5 billion in funds to offset excess diesel emissions and boost zero-emission vehicles.
The settlement for Volkswagen is really the first step that they've made publicly after the admission of fault in September of last year. And so the amount of $15 billion far and away the largest amount in U.S. history, is really the first step in terms of setting aside funds to either repair vehicles or potentially buy them back from owners. I think, again, this is just the tip of the iceberg in terms of what they can expect from other follow-on lawsuits from certain states such as California that are going to go forward for even more action. And the impacts are going to continue on further with impacts to future product development and what Volkswagen can achieve with kind of a diminished budget going forward.
When we come back from the break, we'll take a look at how the oil market is faring after Brexit. Please stay with us.